Welcome back, everybody. Earnings season has started and we've already had major companies announce. And today we're talking about 4 of my portfolio companies that announced earnings to see how they've done over the past quarter. And those 4 companies are Google, McDonald's, MSCI, and Visa. So let's go ahead and get started. Now, Google is first up, and compared to their peers, the stock has been trading down a little bit over the past few months. So let's take a look at what they actually reported. Now, overall revenue was up 15% year over year, operating margin up from 28% last year to 32% this year, and earnings per share up 37% from last year. And if we take a look at the breakdown from each business segment, you had search revenue up 12%, YouTube up 12% as well, Google Network was actually down about 1.5%, but then Google Cloud was up 35% and continues to accelerate. So overall, it was eerily similar to what they announced last quarter, but regardless, once again, Google simply knocked it out of the park because they're getting good growth in just about all segments, and especially in places like YouTube and Cloud. Improving margins 4 percentage points year over year is good as well. And again, it looks like search is holding strong for the time being, still growing over double digits. And if we look at how they're doing at managing costs, which is another important thing I have on my list to monitor, you can see that sales and marketing is up just slightly from a year ago, about 5%, but G&A is actually down 10%. And if we take a look at stock-based compensation, it's up slightly from a year ago as well, about 2% or so, but they've continued to aggressively buy back shares, so net shares outstanding is going down. But again, Google's story this quarter is pretty close to what it was last quarter. Their growth story is still there, cloud continues to accelerate, costs continue to be more under control, which means that their profitability is going up. And speaking of that profitability, you can see the trajectory of Google Cloud continues to go way up, with a 7x increase in operating income compared to a year ago, and a 66% increase in operating income compared to just last quarter. So that's a really good story for them, especially since cloud is their highest growth segment. And honestly, there's really not much to nitpick about Google's earnings, and the market agreed, having the stock up over 5% in after-hours trading. So obviously, Google's a beast, and they're executing at a level that's better than they were a year ago, but I think the real question for investors about this stock is more long-term in nature. Because first off, are they actually going to be broken up? Because in August, a judge ruled that Google has an illegal monopoly in search and text advertising, and the DOJ is considering a breakup as a remedy. And second, and obviously related to this, will they continue to keep their search dominance? Because not only is there a risk that a breakup of parts could lead to less of a moat for Google, but the potential of not being the default choice on Apple iPhones anymore. And then this week, the news that Meta, yes, Meta, was specifically working on search to be less dependent on Google and Bing. And if you've been watching this channel, that shouldn't have come as a surprise to you. But I'm more interested to see if their models can help them get market share as it relates to search, because that's one big opportunity that I don't really hear a lot of people talking about. So let's go ahead and talk about it. Now, if we're being honest, historically, search on Facebook and Instagram has been terrible. I mean, it just doesn't perform well at all, in my opinion. It's so bad that I don't even use it most of the time. But what if all the integration with Meta AI and all the learning and interactions across the 3 billion people on their platforms actually help to make search better? Because, for example, search on TikTok is actually pretty darn good. And obviously, Google search and YouTube search is great. But if Meta can improve in that area, it's a huge opportunity because of the unique characteristics of their platforms. Just about everyone has a profile, so they know things about you personally. And just about every business in the world has a profile as well, so they have a way to connect you and initiate commerce. Plus, you spend most of your time online, usually in one of their apps, if not YouTube or TikTok. And lastly, and maybe most importantly, their content and user data is not public-facing to the internet, so it's literally a place that Google can't get to. And to me, those are distinct advantages if they could just get their stupid search to actually find something that I'm looking for. Now, ultimately, these are tough questions to answer, but not anything that is likely to impact the stock over the short term. But if you're a long-term investor in Google, I would at least try to imagine what the company looks like and what it's worth to you if their search dominance starts to get eaten away a little bit over time. Now, as for me, I'm holding my Google shares, but I will admit that I'm tempted to sell them and put that money into Meta because I just really believe in what Meta is doing right now. I think they're executing at a high level, and they're one of my highest conviction companies that I have in my portfolio, right up there with NVIDIA and Amazon. And if they can put together a high-quality search product with their distribution and the time and app that they have on a daily basis, I just think that would be a huge deal. But Ultimately, we'll see, and we may hear more about that specifically when Meta announces earnings this week as well. Now, McDonald's is my longest held holding in this portfolio, as I started the portfolio with buying it in December of 2022. And if you've watched this channel for a while, you know that I love McDonald's and I have a personal connection with the company because of all the great family memories that I have with it. But lately, there's been quite a bit of drama with the Golden Arches. Last quarter, they had a double miss on earnings and revenue, with sales having negative growth, and their overall outlook caused me to trim part of my position. There was some controversy when they had Donald Trump in on a campaign stop to work the fry machine, and they were just in the news for an E. coli outbreak that was tied back to their quarter pounder, specifically the slivered onions that they used from a regional provider. So with all that, McDonald's stock must be in the tank, right? Well, no, McDonald's is actually up over 18% since last quarter's earnings report, easily outpacing the broader market, and that includes the drop they had with the E. coli news. So again, a great example of how it's hard to predict how the market's going to react over the short to medium term, but as an investor who focuses on company fundamentals, what you hope is that over the long term, the market will act a little bit more rationally, and we can take advantage of it when they don't. But with all that being said, let's see what McDonald's actually reported this quarter. Now, they beat Q3 estimates on both revenue and earnings per share, with revenues up about 3% year over year and earnings per share up about 1% on a non-GAAP basis. They also declared a 6% increase in the quarterly cash dividend. Now, in terms of the E. coli outbreak specifically, they said it didn't impact their Q3 numbers, but it was obviously concerning and something they're taking very seriously. And this, I think, highlights a point that I've mentioned about McDonald's in the past. I feel like McDonald's is just a really well-run company. Like when I look over their transcripts, I look at their plans whenever things happen, they just do things that, in my opinion, inspire confidence that they really understand what they're doing and they have a handle on it. And another good example of this was how they handled the Donald Trump situation. As we've talked about on the channel before, the political landscape in America right now is very heated on both sides. So of course, having Trump at a McDonald's serving fries upset some people, where they started giving bad Yelp reviews for that specific location, and McDonald's addressed the issue with their franchisees, basically saying that McDonald's does not endorse candidates for elected office, and that remains true in this race. We're proud to hear of President Trump's love for McDonald's and Vice President Harris's fond memories of working under the arches. Upon learning of the former president's request, we approached it through the lens of one of our core values. We open our doors to everyone. And to me, this is how businesses should be run. Like, we're a business, right? We're not picking sides. We're not saying one is good and one is bad. We're open to everyone. And this was just another example of McDonald's management really understanding how to deal with situations when they're not always the most comfortable thing. And I think the E. coli breakout was another example of that. But now, that being said, there are real headwinds for McDonald's going forward. Like, where's the growth actually going to come from? And can they gain back low-income customers with continued focus on value? And then lastly, can they get sales going back in the right direction just in general, both in the US and internationally? Now, personally, I think the stock is probably a bit overvalued right now based on what their current outlook is, but McDonald's is a long-term hold for me simply because of my attachment with the company. And I've talked about this before. That's an approach that not everyone's going to agree with, and that's okay. My opinion is we don't need to be robots about this. Like, if you want to hold a company because you simply like the company, even if it doesn't meet all the special metrics that everyone else thinks are great, that's okay. It's your portfolio. But in addition to that, there are some good things on the horizon for McDonald's over the next year. The $5 meal deal has helped, and U.S. comp sales were actually up slightly after being down last quarter. And they have plans to roll out a more permanent value offering early next year. Plus, part of their challenges are simply an industry-wide issue, and McDonald's comp sales still outpace the industry as a whole, showing that they still have some strength compared to their peers. Also, as they go into 2025, the year-over-year comps are going to get a little bit easier to beat, as 2023 was a really great year in terms of growth, which made it tough in 2024. So overall, I think McDonald's is in a challenging spot, but they have some encouraging things on the horizon, and they have a management team that, in my opinion, knows how to handle obstacles in the right way. So obviously for me, it's going to be a hold, and we'll just see what happens. Okay, next up is Visa. And if you remember, last quarter, there were a couple things that I wanted to start monitoring for them going forward. There were a couple things in this report that I thought were interesting for us to kind of take note of and monitor as we go forward. And that's namely revenue growth and expense growth. But the other area I wanted to watch is operating expense growth. because if you look at the non-GAAP number, they went up 14% year over year. So let's take a look at what Visa reported. Visa beat on both earnings and revenue, and the stock was up about 2% after hours. But let's take a look at the actual numbers. They had net revenues of $9.6 billion, up 12%, non-GAAP net income up 13%, and non-GAAP earnings per share up 16%. Now, in terms of key business drivers, payments volume was up 8%, cross-border up 13%, and processed transactions were up 10%. Plus, they executed share buybacks and dividends totaling a whopping $6.8 billion in the quarter and $20.9 billion for the year. And lastly, Visa increased their dividend by 13% as well. So the nice part about this is they were better this quarter than they were last quarter pretty much across the board. You had revenue, net income, earnings per share, and payments volume all up from last quarter's growth rates, which is definitely nice to see. And if we compare how they did to their own guidance for the quarter, it looks like this. In terms of revenue, they expected low double digit, and they hit 12%, which definitely meets that criteria. In terms of operating expense growth, they expected high single digit, and they were at 11% for the quarter, which was a little high, and so they missed. But then for earnings per share growth, they expected the high end of low double digit, which is just confusing, but okay. And they were at 16%, so they definitely hit that. And then if we just compare their full year guidance, it was a similar story. They had guidance of low double-digit revenue growth, high single-digit to low double-digit operating expense growth, and low teens earnings per share. And they basically hit 10% net revenue growth for the year, 11% operating expense growth for the year, and 15% earnings per share growth for the year as well, which means they basically hit their forecast. Now, if we look at what they're forecasting for Q1 2025 and the full year 2025, it's high single-digit to low double-digit revenue growth, high single-digit to low double-digit expense growth, and it's high end of low double-digit earnings per share growth. So maybe slightly lower than 2024, but still in the same ballpark, at least for now. And this is the thing about Visa, they're just a machine. If you go back to each of my earnings updates for Visa each quarter, they probably sound pretty much identical because Visa just keeps going, processing payments and doing its thing. They hit their guidance, they provide solid growth and shareholder returns with both dividend growth and also buybacks. The only real update or new concern from last quarter is obviously the DOJ looking into Visa for having an illegal monopoly as it relates to debit card networks. But if you saw my hour-long video on that topic, then you have a pretty good idea of what's going on with it and what my personal perspective is on it. But overall, Visa just doing what Visa does, ho-hum, TikTok, so boring, right? But so good. Up next is MSCI, and MSCI is a stock that's had a really nice comeback this year, up over 23% in the last 6 months. And their Q3 earnings beat top and bottom line estimates, with earnings per share beating by about 9 cents per share and revenue beating by about $8.5 million. So let's take a little deeper look at what they actually reported. Operating revenues were up 15.9%. Organic revenue growth, which is outside of acquisitions, was up 11.1%. Recurring subscription revenues up 15.4%, asset-based fees up 19.5%, operating margin was over 55%, and adjusted margin over 62%. Now, if you compare those to last quarter, basically their growth rates and margins were better across the board. MSCI executed about $200 million in share buybacks in the quarter at an average repurchase price of $522 a share, which seems like a pretty good use of capital. Plus, they also approved an additional $1.5 billion in buybacks for the future. And as of this video being recorded, the market initially liked MSCI's earnings, starting the day up as much as 5%, but then eventually coming down to be almost 2% in the red. Now, MSCI was a stock that 2 quarters ago really had some obvious headwinds. Their operating margins were down under 50%, their retention rates had fallen, especially for index and ESG segments, but last quarter was a nice bounce back with operating margins at 54% and retention rates back up closer to their previous levels. Well, this quarter was a bit of a mixed bag, but overall generally positive, with operating margins up at 55%, but retention rates were slightly lower than last quarter at 94.2%, with some decreases in retention in the ESG, index, and analytics segments from the prior year. So overall, even though you'd like to see those retention rates higher, MSCI's growth in those segments has still been pretty good, up 14% in ESG and up 11% in index and analytics both. Now, retention rates I would consider to be more of a leading indicator, so it's definitely something we want to keep an eye on going forward, but at this point, the growth is reaccelerating, and that's a positive thing. And we see the benefit of that in MSCI's updated guidance for the year, because they expect slightly less interest expense and a tax rate at the lower end of their initial range. But even with an increased plan for capital expenditures of about $10 million, they're expecting about an extra $100 million or so in net cash and free cash flow for the year above their original guidance. So in general, I thought this was a good quarter for MSCI, but if you remember when I originally added to my portfolio, this is what I said. Now next, in terms of risks, MSCI as a leader in ESG data can be looked at as a positive or a negative, because these days anything related to the term ESG is usually met with one of two responses. One, people love it, think it's great, and that we need more of it. Or two, people hate it and associate it with polarizing political issues. And for those of you that have watched this channel for a while, it's probably no surprise that my opinion on ESG data as it relates to stocks is somewhere in the middle. Because as an investor, I really have zero interest in it, because I don't invest for personal causes or beliefs. I really am only investing to build wealth and make money. And in my opinion, ESG data really isn't a primary criteria that I think is a differentiator that indicates future success of a business. Now, for others who think differently or have a different investing style or believe that it is an indicator of future success, that's great. It's just not how I look at it. And it just so happens that MSCI is a global leader in providing that data. And you can see the popularity by the fact that it's the fastest growing segment out of their revenue streams. But I have it listed as a risk because anything that's polarizing or can be impacted by changes in political ideology or social narratives, to me, is a risk. Now, up to this point, it's been a positive for MSCI and the revenue growth, but we'll just have to see how it progresses. Now, in terms of how that ESG narrative has progressed, again, it's a little bit of a mixed bag. Revenue growth has been slowing over the past 4 quarters, but then seems to be on the upswing in this last quarter, with the retention rate taking a big hit in Q1, but then bouncing up and down a bit over the last couple quarters. So what does that actually tell us? To me, at this point, it simply says, look, it's a revenue growth driver right now, but the retention rates are a little bit wonky, so it's something we should continue watching and monitoring to see what happens. But overall, regardless of what the market thinks about MSCI's quarter, I thought it was pretty good, and I'm holding my position. Now, if you want to see my original analysis of when I added Google and MSCI to my portfolio, you can watch that by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.